Never fear the market changing ever again. In today's video, I'm going to show you every market condition we can be in and how to identify these conditions so you're always one step ahead of the market. My name is Luke Burton, co-founder of Not Just a Trade. I have 6.5 years experience trading the Forex markets, and today I'm going to give you some of the most important fundamental concepts we use on a daily basis to read the Forex markets. I'm going to show you on Euro USD, but these concepts work on every single pair in the market. Knowing how to read all of these conditions is essential if your goal is to become a very skilled trader. Let's get into the video. There are 3 types of market structure or market cycles. When you learn to read all 3, you'll never fear the market changing because you'll always be one step ahead, knowing exactly what these changes look like and how to identify all 3. At NJT, we have structured our course video for you to understand and trade each phase of the market conditions we're about to discuss today, with clear processes on how to trade each phase and the logic for who is behind each phase, so you know the entity behind the system. We are not just about reading patterns, we understand the logic of why and who is behind these structures, so you can trade with a narrative and logic that makes sense. You should be so clear on how to read the direction using our concepts, then the entries become easy. So the first structure that I want to show you is range structure. This is the most common delivery and the most frequent. It will also be the most enticing to trade because the psychology of this structure is to get you involved, emotional, and losing your money. So when the market condition does change and it's more fruitful for you, all you're doing is coming back to break even or barely making profit, and you stay in this cycle of frustration and loss. So although you may not have a strategy to trade this structure, it's arguably the most important one to be able to identify and read. So to just draw this structure on for you, so you have a visual representation of what it is, it's price when it's just sideways. Now, every single market out there has sideways price delivery because every single market is controlled and manipulated by the banks. And this is the way that they get involved in their positions in the market. When they stack price sideways, most retail people understand this as consolidation, and they understand to stay away from consolidation. Now, if you can understand how to get involved in consolidations and ranges, the next part of the move in the market, we know to be the initiation phase. So if you can get involved in this range at good locations, you're potentially going to give yourself the biggest risk to rewards in the market. So this is a whole understanding of how to see ranges. But an entire price delivery that I'm going to show you today, which is one that we use at Not Just a Trade, is sideways range, initiation, mitigation phase, and continuation down back into the low. This is a full price cycle. This is literally what every single market does. In order for the banks to get into the market, this is exactly what they have to do. So today we're going to break down each phase. So we have range structure phase, we have initiation phase, we have that pullback phase, which is after the initiation, that pullback phase, which is a trend. And then again, after the mitigation of this range, we have again an initiation phase or continuation phase. Now, if you can understand each structure as it's being printed and you have rules to understand exactly what these structures look like and how they can be represented in the market, you will understand every single market condition. So when people say that the market is going to change, quote unquote, it's only going to change into one of these 3 market conditions that I'm going to show you today. So once you understand any of these conditions and you add on framework to be able to give yourself good locations to trade from, there is literally no worries in the future about anything because you can trade every single market phase, you can understand every condition, and you can anticipate what is going to happen next based on the price delivery that's on your screen right now. If we're at a phase of mitigation, you know what comes next, that potential initiation phase or continuation phase to the downside. If we're in a sideways range phase, you can anticipate that the next phase of market is going to be an initiation phase. Once we start a pullback and we see intention in the opposite direction, you can understand that we might move into a trending phase. And when we get that mitigation phase, it's either again, it's going to be that next initiation phase, or if it moves slower, it's going to be that trending phase to the downside. So you can anticipate exactly what price is going to do before it even happens by understanding this entry model here. This is a full price cycle. This is a completed price cycle in the markets. So the next structure is trend structure. Most people can only read this one, so they build strategies based on market only trending and always get caught out when the market is ranging, and they never get their pullback when the market is initiating. This is the easiest way to trade, and that's why it's so heavily focused by so many educators and Instagram gurus. However, the market only trends around 30% of the time. So you want to understand what the market's doing the other 70% of the time, so you can start to anticipate and trade any market conditions. Trend structure is higher time frame order flow presented as a trend on the lower time frame. That can either be a 15-minute order flow represented as a 1-minute trend, or it can be a daily order flow represented as a 1-hour trend. So what does that look like? Everyone's done baby pips. Everyone's got an understanding of what trend structure looks like. It is initiations, pullbacks, initiations, pullbacks, initiations, pullbacks, initiations. These initiations break structure lows, and we get lower highs and lower lows printed into the market like so. And if we see it on the opposite side, we get an initiation, pullback, initiation, pullback, initiation, pullback, and initiation. And every one of those initiations breaks a previous swing in the market. We then get the higher highs, higher lows, higher highs, higher lows, higher highs, and higher lows. Very simple. Everyone knows what trend structure looks like. It's very easy to read this market condition, and it's very fruitful to trade this market condition, because once you add your framework, it's very easy to look at getting involved in these sorts of markets. So that's why most people focus on trading the market like this, because it's the easiest way to trade and the easiest way to identify. When I said that the price creates order, this is higher time frame order flow read as a trend on the lower time frame. These are ranges here when price is contained sideways overall. Now, when price initiates to the downside, we've got our sideways range where price is contained between a high and a low. We have an initiation here that breaks structure between this high and this low, which will be this next phase of price. We get that pullback phase into the mitigation, and we get continuation. Now, this is how we learn to read how and when to get involved in price and the locations that we want to get involved in price, because it has to be back somewhere inside this range. So this is that order flow, and essentially all it is we're reading time frames together and understanding that this is a whole buy to sell that has caused a structure break. We're pulling back into good locations and seeing continuation. So this is a buy to sell that breaks structure, pull back, continuation back into this bearish order flow, which is a sideways range overall. So I hope you can see how you're starting to understand how these market cycles can be read and understood, and how you can learn to read higher time frames on the lower time frames and trade with that order flow in that direction. So that's the second structure. And again, we'll go on to the charts in a second and read these structures, and I'll give you some general rules that you can use to trade with these structures as well. And the last structure is initiation structure. This is where price is moving with a lot of momentum. It looks like those times where you say, all I had to do was press buy or sell and I would have made money. That's really fast, aggressive market that moves with a lot of momentum. This is one of the most fruitful market conditions where you can make a lot of money very quickly. If we're in a higher time frame initiation structure, there'll be a lot of money to be made. However, this is the quickest market structure. As soon as it started, it's almost nearly finished. It doesn't last long, normally 2 to 3 days max if we're thinking about intraday, before we start to see a new condition. And this phase is when price is just moving up or down and straight. And remember, if this is a higher time frame move, what's happening on the lower time frame is we are starting to get those ranges and continuations and those pullbacks. But what we're going to see is price doesn't pull back deep in these phases. So we normally just get new ranges created and new initiations, smaller pullbacks where we don't pull back deep, and then we get continuations and again new ranges and continuations in the market. And this is because the banks, the people that actually move the price, are going to be moving price quickly. So all they're going to do is create new ranges to create new positions in the market and then see continuations. So if we can start to understand phases of the market on a higher time frame, and we can combine some of the understandings and the structures that I'm showing you today, we can understand direction very quickly, and we can understand where we want to be trading based off these sideways ranges because of the condition that we're in on a higher time frame. So this is how you can start to read timeframes together and start to read and understand how you can put trade ideas together with higher time frame and lower time frame structures. So now let's get into some actual examples on the chart. So the first phase that we're going to dive into is initiation structure. Remember, initiation structure is when price doesn't pull back deep and we don't get those nice clean moves like we see in a trend where we get those nice deeper pullbacks before continuations. It is when price is just moving with very clear, a lot of momentum and a lot of intention to the downside. So price has come into this point of mitigation here on the higher time frame. We move into sideways range structure. Again, we're just contained sideways. Once we break out, we see a lot of aggression and speed to the downside. Now, this is a point of mitigation on the higher time frame. So if we're anticipating that this is a sideways range that we've seen previously, we've initiated to the downside, price can do whatever it wants. At that point, we could even move down. When we get to that point of mitigation, which we're seeing here, we expect that the next phase of price is going to be an initiation phase, which is more aggressive to target this low for that range, initiation, mitigation, continuation. So we're at that point of mitigation here now. Price again starts to move sideways here in the market. So we get range structure at that point of mitigation. And then we start to see a lot of aggression and speed, which we expect to see in an initiation structure. Now, this is a higher time frame initiation structure. So we expect that just because this is higher time frame move, it doesn't mean it's just going to move straight down. The price doesn't move like that. What we're going to start to see is price being contained sideways in this initiation structure to the downside, but we're not going to see those deeper pullbacks like we see in trending structure. All we're going to see is price moving aggressively, new sideways ranges created, price moving aggressively, new sideways ranges created. And this is the phase of price that we're in. So if we can start to identify that we can see when price is ranging previously, and we expect that this is going to be that mitigation continuation, we know the phase of price before it even comes into the market. So we anticipate that when we start to see this aggression and when we're starting to see these new ranges being created, that we're in that very aggressive market condition. So we start to trade the market in that way. So as we see, we get aggressive move down, price is then moving into range structure. We're still in a higher time frame initiation, so we expect that this is going to happen. Again, when we're in range structure, we can add on our framework and find great sell high continuation opportunities. Price then breaks out of the range here and we initiate to the downside. When price is moving very aggressively, you have to understand that we're not going to see those deep pullbacks. So we're not going to get range initiation, mitigation, continuation. So you have to learn to read and trade the sideways range market condition so that you can trade these initiation phases and you're not only waiting for those pullback phases in the market. So again, price initiates, range, initiates, range, initiates. And what these are creating now is future mitigations. So when price comes back into these locations in the future, we expect price to react out of these ranges that have been created. So again, we get initiation, range, initiation, range, initiation, range, initiation, range, and initiation to the downside. Now, inside these structures, inside this whole initiation phase, we can still see the other market conditions. So we can still anticipate that we might start to see new ranges and we might get A to B continuations as we see here. So we get our trend, A to B, we break structure, we pull back into the range, and we see continuation. So we can still get those range, initiation, mitigation, continuations. They will happen. They're just not going to happen as frequently as price creating new ranges and just initiating out. So that's how we understand that phase of the market. We anticipate it by understanding that we're in a range, initiation, price can do whatever it wants, mitigation, continuation, and that's that full price cycle. When we're in that point of mitigation, which we see here, we expect that we might be in that continuation phase, which is that initiation phase in the market. So we wait for new ranges and we trade those new ranges, anticipating those aggressive moves. Now, this is also where, for me, I'm happy to take more profit. So my usual risk to reward is a 1 to 10. However, in these initiation phases in the market where I'm expecting bigger moves, I will happily take 1 to 15s out of these markets. So it's more fruitful market to trade. So when you can understand these markets and you understand that ranges are created in these initiation phases, you can take more profit out the market. So it really pays to understand this market phase. So now after we see that initiation phase, we get a reaction from a higher time frame point of mitigation, as we see here. Again, this is just the previous range that we can see left. We've initiated higher, we've moved in whatever moves we've had, we've initiated lower. We're expecting that this is just a reaction point in the market because price is in that initiation phase and it's targeting a low that is below this area from a previous range that price has created here to the downside. So we might get something that looks like this. This just then becomes a reaction point, which we're seeing in the market right now. And we're in that phase of continuation, that initiation phase to the downside. We can also still get price moving sideways in this phase, but we expect that price is going to react out of previous ranges, which is exactly what price is doing from here. So we get a previous range to the left, price is now reacting out of this range here. So now price is starting to slow down. We can see that overall, even though we've created that A to B, which is the start of a trend, we don't have another higher low yet. So in order for a trend to be considered a trend, it's not just about seeing an A to B in the market that has caused a structure break. It is about seeing that next higher low and a higher high. We cannot consider a trending structure until we get a higher low and a new higher high printed in the market. We are still in range structure if we create an A to B and we don't create a higher low and a higher high. We are still in ranging structure. We are still contained sideways in the market. So as we see here, we get our A to B that causes a structure break, but we don't see that next higher low printed in the market. Price just continues to move sideways. So what market condition are we in? We are in a sideways market condition overall. So again, we trade sideways market conditions different to how we trade trending market conditions. Every phase of the market is traded differently. We have different framework. We have different understandings and processes for different market conditions, so that we don't get caught up only looking at market and trends. We see and understand how to trade each market condition. So as we see price move sideways overall, we do get to B, we do create that higher low and we do eventually create that higher high. So as price is now broken out and created that higher high, and as we can see, we can still have trending structures inside ranging structures. So we can still understand trending structures inside ranges and we create that higher high. What happens after we take out the range high? Price moves right back into the range. So this is an understanding that price is now still in range structure. We are still sideways. We are still contained sideways overall in the market. When we're breaking out of these highs and lows, these swing points, if we don't, we expect that after a range in the market, the next phase of price is an initiation phase. So if we're not seeing that initiation phase in a very clear, impulsive and aggressive move, and we're taking out these highs and taking out these lows and moving back in, we are still contained sideways in range structure. So as we can see, price did move out and we expected an initiation phase in the market. However, price moved right back in to the downside. So we adjusted the range from here to this new high and we're still sideways overall. And again, we can add our framework on and trade that understanding and that sideways market. Now, like I said, we can get initiation phases and trend phases inside a different phase. So inside a range, for example, we can get trend, and inside a range, we can also get initiation. So we see we have a range here, an initiation that created this low. Again, it doesn't matter what price does in between here. We come back into that point of mitigation. And now what do we expect? An initiation phase in the market. So what do we expect? Price is going to move very aggressively and we're just going to create new ranges and see continuation. So as we see, we're at that point of mitigation here. Momentum shifts bearish. We see the aggression and speed in the market, and price just starts to create new ranges and initiates, creates new sideways ranges and initiates, new sideways ranges and initiates to the downside. So we can see that we're in an initiation phase, which we expect because we've had that point of mitigation, and the next target will then be the swing low for continuation. So we can understand that the initiation phase is coming, because we've had a point of mitigation where we can see that next phase of the market to the downside. So we can start to anticipate that. We can start to understand that the market is not going to pull back deep because we're not in a trending phase of the market, and we're just going to see new ranges created and new initiations to the downside. And again, what does price then do? We take out the swing low here, and what do? We expect that because we've gone from a sideways range, we should now be in an initiation structure and we should continue to the downside. Now, what did price do? We started moving sideways, and we saw new intentions coming into the market. So if I just zoom into this area here, so we went from, we can see this red box, this is that initiation structure to the downside. We went into range structure now, we started moving sideways. As we can see, we got an A to B created that caused a structure break. So now we could potentially be moving into our trending structure. But what do we need to see in order to see trending structure? We need to see a high, a low. We have to see a higher low and a higher high printed in order to be trend structure. Otherwise, price moves back into the range after creating that A to B here, and we're still sideways at that point. So we can be contained sideways at that point until we get that higher low and higher high, and then we can identify that we're in a new structure in the market, a trend structure. So as we see, price is contained sideways overall. We do get an A to B. So now we can start to think that trend may come into the market, and we can trade our trending systems the same way that we trade our ranges when we get A to Bs, because then we're just thinking about trading locations and making sure we're buying low and selling high. If we're trading in a bullish trend, we want to buy low. If we're trading in a bearish trend, we want to sell high. If we're trading in a sideways range, we want to sell high and buy low and avoid the middle. So we can see we got an A to B, we got the higher low, and we got the higher high. So now we've moved from range market structure and range conditions to now trending conditions in the market. So now we wait for those pullbacks and continuations of that trend, that trending market structure. Now we can see after we get the trending market structure, price starts to move very aggressively to the upside, creates new sideways ranges, and starts to continue. So now we can see that we've gone from trending phase to now price is actually starting to move very aggressively and move into an initiation structure in the market. Why? Because we're getting new sideways ranges, we're initiating, and we're getting new sideways ranges and initiating in the market. We're not getting those deep pullbacks, we're moving very aggressively, and we're not getting those really clean trending pullback structures in the market. So as we can see, then we're still, remember, even though we're still in this initiation phase and trending phase and ranging phase, we can understand that price has broken out of this larger sideways range, and this is what understanding higher time frame structures and conditions is all about as well. And we've moved right back into the range. So even though we're trending and we're initiating here inside the range, we're still overall contained in this sideways range. And as we see, price takes out the high of the range, and what do? We move right back into the range. So all that happens is this range just becomes very large. We just see a very large sideways range, and then we can start to trade structures that we see inside these ranges. And again, this reaction here is from a whole higher time frame buy to sell, and we react from the open here. So again, we're starting to create, like I said, remember at the start when I said that we get trending structure is just higher time frame order flow, as we see here. If we're to zoom out, this is a whole buy to sell, pull back to the open, mitigations, we expect continuation, and that creates that continuation in the market to the downside. So trends are just higher time frame order flow being printed into the market. So as we can see, we took out the swing high, we mitigated the open of that whole buy to sell on the higher time frame. Price has moved back into the range now, so we're still in higher time frame range structure, but we can start to read what sort of new structure we're getting inside this range. Now let's zoom in here. As we can see, we've got A to B printed in the market. We get the lower high and we get the lower low. So now we're in trending market structure here, as we can see. So now we can start to play trending market structure, which again is a different phase and also requires different processes in order to trade. But we can understand every market phase and every market condition. now that we're moving into trending structure and we get those A to Bs that cause structure breaks, and we get those lower highs here and those lower lows, we can still create new ranges here and then initiate and break structure. But because we know that we're in trending structure, we have very clear direction in the market, which is down, it's bearish. So as we see, we get that lower high and lower low, lower high and lower low. We create the lower high and we create that lower low. Now we can also use our range initiation, and again, we in that initiation phase on the lower time frame, as we're seeing, once we break out of that range, we expect that price is gonna initiate to the downside, which we do see. We don't see any deep pullbacks, we just see new sideways ranges and initiations created in the market until we start to react out of this sideways range between the candles, which becomes a reaction point, which initiates our pullback in the market, where price is going to pull back a little bit slower in those A to Bs. So we can start to understand and read every single market condition and every single market phase before and ahead of time, because we know every single we know every single structure that price can create, because we have an understanding of this full price delivery: range, initiation, pullback, mitigation, and continuation. We can anticipate that when price breaks the range, we're in an initiation structure. So when we break the range, we're in an initiation structure. When we react out of a mitigation, that can initiate a pullback, which we do see, and we also get a sideways range structure on the lower time frame. We get the pullback, mitigation, continuation. So once we get that mitigation, which we see here, what do we expect? We expect that the market is going to move in that next continuation phase, that initiation structure to the downside. So we trade on the lower time frames, anticipating that phase where price just creates new ranges here and just initiates to the downside. As we see, new range initiates to the downside. So that's why it pays to understand how to trade sideways ranges, so that you can trade during this phase of the market and you can trade during the sideways range phase of the market. So if you're only trading trends, you're only going to be able to trade certain market conditions. Now, that's what we see quite a lot on, on Instagram and so on and so on. People are only able to trade these market phases, and they take a lot of losses when price is in sideways phases or when we're in initiation phases, because we don't get those pullbacks in price. And that's why it pays to understand every single market condition and understand every single market phase. So as we know, we're still in this sideways range here. Let's just get rid of this. So as we know, we're still in this same sideways range that we've been in, because price has taken out the high and we've moved back into the range, but we're getting trending structure inside this range. So we're getting those lower highs and lower lows. So now we can add on our framework and we know where price is targeting, which will be this next low for continuation to the downside. So I hope you can start to understand that and use these rules that I've given you today and these understandings that I've given you today to understand how we use RAMC, how we understand the market phase, how we trade the different phases, and the rules that we use and understand to identify these phases, so that we can start to trade and use our processes to trade every single market condition and get into every single market move. Remember, the market is going to be easy to read when you can understand its framework and you don't force what you want into the market, but you actually read the market from its perspective. You need to stop wasting your time only learning one way of seeing the market. Some people just don't have the knowledge, experience, and skill that we have on the charts. If you only trade trends, you're only going to have around a 20 to 30% win rate. If you trade all three market conditions, your win rates and your profits are going to be so much bigger, because you can anticipate phases of the market before they even happen. That's why our risk to rewards are a minimum of 1 to 10, and we can trade any market conditions. Thank you all for watching. If you want to join us and learn more about how we trade these structures, join through our website link below at notjustatrade.com. We also have a public Discord channel that you can join, where you can ask us any questions, send in your charts, and lots of free exclusive content in there for you. You can also find us on Instagram using the links in the description of this video. Don't forget to like and comment, and we will catch you in the next video.